Hi, this is Gene Trowbridge with the law firm Trowbridge and Nieh. We're syndication attorneys, securities attorneys, and we help our clients do the paperwork so that they can raise money from their investors to do any number of things. The investors usually provide the equity for the project. And this is a success story about a different approach to investing in real estate. In this case, my client wanted to raise money in a blind pool approach with a goal of investing in other people's offerings. The client had found that there were very good operators out there who were asking for $1 million minimum investment from an investor to invest in their funds. So you can imagine this is a very experienced syndicator that would ask for $1 million per investor. So our client decided that there was an opportunity there, and they decided to pool money from investors and then go out and make investments of a minimum of $1 million each in a couple different offerings that yet to be identified. So their investors would get diversification by being in multiple offerings, and their investors who couldn't invest $1 million themselves would get to be part of a larger offering. So some people call this a fund of funds approach. Some people would say, well, what your client did, Gene, is put together a fund where that fund went out and invested in other people's funds. Well, maybe that's a good terminology, maybe it's not, but that's exactly what happened. So in this case, my client set out to raise a minimum of $1 million because that's the business plan. They were going to have $1 million to invest in anyone's offerings. So that was their minimum, and the maximum they set out to raise and did raise was $10 million. And then as they hit the first million, they could break impounds, which means they can start using the money to make their investments. From the investors, they were going to sell $10,000 units, and the $10,000 units led them to a minimum purchase price for every investor of 10 units. So it was a $100,000 minimum, but the units were 10,000. So people could invest, 100,000, 140,000, 200,000, whatever, as long as it was $10,000 increments after the first $100,000. Now, this plan was to be in existence for 5 to 7 years because that seemed to be the operating period that these other funds seem to be working under. So that's what we disclosed to our clients. And what was happening in this offering is there was going to be an 80-20 split between the managers of this fund and the investors. So this fund would invest in someone else's deal. At the appropriate time, someone else would send a check to this fund, and this fund would split the cash flow 80-20 with their own investors. Now, they were going to do quarterly distributions as soon as there was some positive cash flow. So it would really depend upon when the fund that they invested in started generating cash. So my clients would get one check and they'd get one K1 at the end of the year, but they would distribute the cash amongst their investors, and then they would create their own K1s for this particular LLC, which was that fund. My client set out to take a 2% acquisition fee on the amount of money raised. So if it was going to be $10 million, they were going to get a $200,000 acquisition fee from their investors. They were going to take an annual asset management fee of 2% of the cash flow received by the fund. And then if in fact the fund with all these investments ever wanted to sell to another fund, which happens in these funds of funds, my client had established that they would get a 1.5% disposition fee based on the value of the fund as it was sold to someone else. So they go out to the marketplace, and their goal is to buy an undetermined percentage interest in some of these other offerings. Each offering had to have at least, or each offering was going to require at least $1 million minimum investment, and our company was set up to do this. And depending upon how much they invested in each fund, they would get a predetermined percentage of ownership, but we weren't sure what it was going to be depending upon the size of the fund. Were we investing in a $50 million fund, $1 million, or were we investing in a $500 million fund at $1 million, which is exactly what they did. They did find a $500 million fund that they invested $2 million in, and then they found a couple of smaller funds where they invested the $1 million. So that's kind of an interesting success story for, yes, it's real estate related, but it's a different approach. And the approach is to allow investors who can't get in those great big funds by themselves because they don't have enough money to participate with other investors to get in those funds, and then have their fund invest in multiple other funds for diversification. So it spreads the risks, it promises a good return, and it is a good approach. And we've done quite a few of these fund-to-fund offerings, but I thought I would talk about this one. And if you have any questions on how you might do something like this yourself, be sure to contact us. Go to our website, and which is tnllp.com, tnllp.com, and schedule a consultation with one of our attorneys, and we'd be glad to talk to you about it. So this is Gene Trowbridge, the law firm Trowbridge and Nieh. We are often putting new videos up on our YouTube channel, so why don't you subscribe? We'll be giving you new and important information as we go along. And so right now I'll say, well, I'll see you in the next video. Bye.